Today, I want to talk about how AMC is back on that Regulation SHO Threshold securities list. The cost to borrow fee and FTD numbers fell off a cliff back in May, but it seems like it was short-lived only for a few days because AMC is back on that threshold list, the cost to borrow fee is spiralling, and there's tons of major AMC catalysts. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Biotech Moose tweeted saying, look at that figure with FTDs. Hedge funds doubled, tripled and quadrupled down to kick the can for more time. They hope retail will sell after their official non-stop downward price push, but they guessed wrong. You can see back in 2021 the number of FTDs was actually very minimal when the AMC price was at its highest, but ever since then they've increased the number of FTDs as they've been doubling, tripling and quadrupling down on their manipulation to try and drop the AMC price. While they have successfully dropped the price, there's two things. One, they have not convinced retail investors to sell, and by dropping the price, they've doubled, tripled and quadrupled down on their short positions. They have not dropped the price and closed out of their shorts. They've dropped the price but doubled, tripled and quadrupled the number of their shorts. That means they're more overexposed now and more heavily over-leveraged now than they were back in January and in June of 2021. They're effectively stuck between a rock and a hard place because they're more overexposed and over-leveraged, and they're in a worse position because retail investors have still not sold and they have even more short positions. Especially as these shorts are now impossible for them to close without a massive increase in the AMC price followed by a squeeze. Obviously, by covering off and properly closing out of all of these FTDs, all it'd do is push the price of AMC back to $70 per share, at which point they still have all of the original synthetics, which would cause the squeeze. Especially because the price of AMC running from its current area back to $70 per share would cause many hedge funds out there to end up being liquidated and margin called, obviously kickstarting that squeeze. So therefore all they can do is try their best to continue pushing the price down and hope AMC goes bankrupt, because obviously retail are not selling, and therefore either AMC goes bankrupt or the shorts at some point will be forced to close their positions. But as Stonks Batman pointed out, he said the end of May had some of the lowest FTDs we've seen in recent times. However, the following month on June 23rd, the number of FTDs was so high that it's ended AMC back on that Regulation SHO Threshold securities list. That means that not only are these FTDs back in full force, but also the cost to borrow fee will again be spiraling out of control. And again, we can already see that because over the last 2 or 3 weeks, the AMC cost to borrow has increased back from 40% already up to 200% per share. I expect the number of FTDs to continue increasing and this cost to borrow fee to continue spiraling back over 1,000%, back over 2,000% and even higher. And as Dade Murphy tweeted, he said the AMC and APE volume is almost even and the AMC cost to borrow is climbing yet again. And he said, I can't wait until APE is taken away and the shorts have nothing left to use as a like-for-like security for their false locates. This is obviously something I've spoken about in the past, where many of these hedge funds and market makers have likely been using APE as AMC locates for new AMC shorts. Obviously there's no AMC shares left to locate and there's obviously billions of synthetics on top of that, and many have been wondering how these hedge funds and market makers still find new AMC shares to locate every single day. Obviously, we know they have those FTX synthetic tokens, which are on the move once again, but it's also likely they've been using APE as false AMC locates because they're like-for-like securities. Obviously, AMC and APE are technically both shares in AMC Entertainment Holdings, and therefore it's likely these market makers have been using available APE shares as false AMC locates. But obviously as soon as that conversion happens, no more false locates for these shorts, and therefore they likely either have to locate actual shares of AMC or start closing out of short positions. And this AMC APE conversion could be a catalyst that causes this cost to borrow fee to spiral out of control even more and causes those FTDs to spiral as well. This conversion could push the AMC cost to borrow upwards of 1,000 or 2,000% to 5,000, 10,000 or even higher percentage points per year. And I think at that point, a short position on AMC becomes very, very unstable very, very quickly, as the shorts will be paying their entire short position in borrowing fees in just one single day. And another catalyst can be seen in this tweet from Sojka. He tweeted saying this message is the most important thing about the AMC movement. He tweeted saying they cannot stop a dividend if we raise the capital. All we have to do is go and see the movies, go and eat some popcorn, buy the AMC merch and a soda, and watch some movies on Voodoo. Obviously, by helping AMC to become profitable, that means AMC can much sooner declare and pay a dividend. And obviously, while AMC pays that dividend to real AMC shareholders, synthetic shareholders must also receive a dividend as well, which is paid out by the shorts. Again, just another way to force the shorts into having to pay out hundreds of millions of dollars, if not billions of dollars, on dividend fees every single quarter. So again, combining those dividend fees with spiraling cost to borrow fees and spiraling FTDs just makes things even worse for these shorts. And something that I think makes things even worse for these shorts is this new bill to claw back bank executive compensation if their bank collapses. Now, I think this bill will likely be extended to also impact hedge funds and hedge fund managers. It says the bill to claw back bank executive compensation if their bank collapsed. For example, in the collapse of Silicon Valley Bank, where numerous executives made millions, has advanced out of a Senate committee. The bipartisan proposal known as the Recovering Executive Compensation Obtained from Unaccountable Practices Act of 2023 would impose fines of up to $3 million on top bankers and bank directors after an institutional collapse. Basically saying that if Citadel Securities went bankrupt, it's likely Ken Griffin would have his annual salary for the last few years forcibly taken under this Recuperation Act. If it's found that hedge fund managers have been acting negligently in their downfall, which is obviously going to happen in the case of hedge funds collapsing as a result of an AMC squeeze, these hedge fund managers would have their salaries taken. I, for one, would absolutely love to see Ken Griffin having his salary recuperated and spread to victims of his synthetic shorting. And as Joshua Sky tweeted, he said the ape to AMC conversion is coming, and then the AMC reverse split is coming after that. 88% of shareholders voted in this favour. And he said the criminal shorts are scared to death of these, and for good reason, because it will likely cause forced closures and liquidations. We know that obviously with a spiralling cost to borrow fee and with shorts taking on giant losses across the wider market in companies like Tesla, Nvidia and many others, there's only so long they can survive. Total short positions across the entire stock market have now reached around $1 trillion, and these hedge funds are currently down $100 billion so far this year, which is 10% of their total short position. Now, as I've said before, 10% may not sound like much, but to a heavily over-leveraged hedge fund using a 7-to-1 leverage ratio, 10% is almost all of their available capital. So as these losses continue, whether it's due to tech stocks increasing further or AMC's cost to borrow fee spiraling out of control once again, it brings them closer and closer to that margin call. And obviously when that day comes that they do indeed see that margin call and liquidations, it would very quickly cause the AMC squeeze. Especially when you consider that just by covering the FTDs from the last 2 years, it would return AMC's price back to $70, at which point the squeeze would begin. So guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.